Hello dear friends and viewers. Assalamu alaikum. I welcome our CA students and other professional fellows in this content. I always try to come with new contents. So there is also a new content in Income Tax Ordinance 1984 based on Finance Act 2022. So I tried to summarize the idea, especially amalgamation and offshore indirect tax rules, which were promulgated in 2022 Finance Act. So this is new idea, especially amalgamation change and offshore indirect tax rules. First, I'll go to change in amalgamation. There a change in amalgamation definition. Amalgamation definition just new changes the shareholding of amalgamating company would have to be shareholders in amalgamated company. 75% should be there. That is, amalgamating company will no have existence, but amalgamated companies will have existence after merger amalgamation. But before the merger, all assets and liabilities of amalgamating company will be assets and liability, also the assets and liability of the amalgamated company or merged company. This is under IFRS 3 and 10. We also revise the IFRS idea or definition. Capital gain on share transfer is exempted if the amalgamation is made through share transfer. This is exempted. If the amalgamation is made in cash or bank transfer, this is taxable. The capital gain is taxable. Unobserved depreciation can be carried forward. The loss of amalgamating company are entitled to carry forward their losses in amalgamated company. The law was not available before this Finance Act 2022. An illustration: there is 3 amalgamating company. One may be B, C, or they have 10%, 10%, 10% share in amalgamated company. Before the merger, they hold the amalgamating company is B 10%, C 10%, D 10%. B might be 30%. C and D may not be available for example. So this amalgamating company must have 75% share in amalgamated company after merger. If it is below 75%, that is before the merger they hold 30%, but after merger they must have 100 minus 30%, the share held before the merger. 75% of 100 minus 30 is 52.5%. So there must have 52.5% share of B, C and D in new amalgamated company. This is the summarized idea of amalgamation. Then we are going for another rule inserted in Finance Act 2022, offshore indirect tax rules. This is actually the section was section 18 to C, subclause C, offshore indirect tax rules. There is new SRO 156 date 1 June 1 2022. This was given in the Paripatra, new Paripatra we have received in September. This is actually many idea of group structure, complex group structure. The IFRS 10 especially, IFRS 10 according to IFRS and its goodwill is there is IFRS 3. So we are revising also IFRS 10. Say each company is UK company. This hold 90% of S company. This is Indian company. And third one is Bangladeshi company. Indian company hold 80% of S2, that is subsidiary company. So there is complex, this is called complex group structure under IFRS 10. So if each company sells the share of Indian company, there is no existence of Bangladeshi company. So this is indirectly disposal of Bangladeshi company share. The portion which are prevail in Bangladesh assets will be subject to tax or capital gain tax if capital gain arises in Bangladesh. Not all share. The share which held or portion the assets in Bangladesh will be subject to tax according to new tax rules. We will not go for any details. Viewers, you will try to always see the rules and time and again you read and get the clear idea. This is summarized way to present you the idea. You will have to go to detail for more knowledge and clear idea. And another slide is main formula of capital gain D. Capital gain D as given in the new tax rules in offshore indirect tax rules. Main formula of capital gain is D into E divided by F. There is D means income from transfer of share of the company. Such share is situated in Bangladesh. That is capital gain. D is capital gain. Capital gain will be multiplied by E by F. E means fair market value of assets situated in Bangladesh on the specified date under Rule 3. Will go BD company will go for Rule 3 summary. And F is fair market value of all assets of company as on the specified date computed in accordance with Rule 4 foreign company. So if we get fair value of for a Bangladeshi company, this is proportion. This will divided by the proportion of fair market value of all assets of the Rule 4 by foreign company. This is the formula given by the Act. This is given by the Act. We will not make any formula other than this. Then summary of Rule 3 and 4. That is BD company share and foreign company share proportion. Rule 3 fair value of assets in Bangladesh. BD means Bangladesh equal to A plus B divided by C as given in the rule. Here A is MC. MC means market capitalization of Bangladesh company share. Observable input IFRS 13 from Bangladesh stock exchange. So will MC market capitalization or share if the share is listed in Bangladesh stock exchange, Dhaka or Chittagong, this will have our observable input. This is also under IFRS 13. We will revise also IFRS 13. This is helpful for the final student and CA final and professional level student. And B means book value of outside liabilities except equity and reserve as per balance sheet. What is given in the balance sheet or financial position? Book value. There is no fair value. Book value will take and this will add it to the Bangladesh company's market capitalization. This value will be divided by total number of share outstanding. Where in observable input is not given, valuation report of CA, CMA or merchant banker will be taken as basis. Where MC is not given, market capitalization is not available, there is according to law new rule, charter accountant or cost accountant or merchant banker may give valuation report. This will be the basis of valuation of share. Rule 4. Rule 4 is, I have summarized, this fair value of asset of foreign company equal to A plus B. Just there is no number of share will be divided. A equal A, here A is market capitalization of foreign company. Observable input IFRS 13 will get foreign company share value from the stock market situated outside our country. That is available. If the company is UK, will get from UK stock exchange the rate or value per share. Also, book value is the outside liability except equity and reserve. Will not count. Book value of outside liabilities means current, non-current, all liability will be added as book value. Book value, there is no market value or fair value. Where observable input is not given, valuation report from CA, CMA and merchant banker will be taken as the basis of valuation of foreign companies MC, market capitalization. So this is the summary of our new rule 3 and 4 given in offshore indirect tax rules. Minimum threshold. There is de minimis threshold, meaning minimum threshold. The asset being share referred in clause C or subsection 18, section 18 to 2C shall be deemed to derive directly, indirectly its value from assets in Bangladesh on the specified date. The value of such exceeds Taka 15 crore and represent at least 50% of the value of all assets owned by the foreign company that directly holds the asset being shared in Bangladesh. If the foreign company directly hold the 50% at least and the value will be 15 crore, this criteria should meet for offshore indirect tax rules. If the value of share being transferred in Bangladesh by the foreign company is below 15 crore and it is below 50%, this will not come or bring under tax rules, will be brought under tax rules, indirect tax rules. This is the given in the rules of our income tax ordinance. Then another slide is exemption. No income shall be deemed to exemption from indirect transfer, offshore indirect transfer. No income shall be deemed to accrue arise to non-resident from transfer outside Bangladesh of share if the transferor, whether individually or with associated enterprise. Dear viewers, you will also read the section of associated enterprise under 107, the definition of associated for transfer pricing. This transfer pricing is also added in these rules. So the associated companies will also be brought under indirect transfer, offshore indirect transfer. Right of management control. If there is no right of management control or voting power is below 5%, it would not be considered for offshore indirect transfer. Share capital exceeding 5% of total share capital. The holding of share must 5% and right of management control or management control is control means exertion of power by the management to appoint director, to appoint a member, or to remove any director. This is management control, absolute power. Voting power, 5% of total voting power. Shareholding exceeding 5%. If the criteria doesn't meet, it wouldn't be considered for offshore indirect transfer. There is a form given in the income tax Paripatra, new Paripatra, SRO 156. This form OIT, offshore indirect tax 1 and OIT 2, rule 5 or 3. So there is this form should be fill up if the offshore indirect tax rules is considered for submission to the tax authority. I have made an illustration. This is main formula is our capital gain D into E divided by F. Capital gain D, receipts, cost of acquisition, less cost of acquisition, what we have received, and less cost of acquisition, into fair value of local company, that is BD company, divided by fair value of foreign company. This is, I have also summarized. There is a lot of written words in given by the government, but I have summarized the idea for you. So receipts from sale, if I have considered the hypothecation figure, 1000 shares, say 2,20,000, and if the receipt is 22 crore, and cost is 1000 share is 5 crore, and this is hypothetical figure. This may be changed or according to MC, and a gain is now 17 crore. This is above 15 crore. So the criteria is met for offshore indirect tax rules. Taxable income is now gain into local share of FB and local divided by foreign company share FB, that is F. E divided by F. If E's value is, we have if we calculate from outside our calculation, this main calculation, if we find this is 6 crore MC or valuation report, divided by 5 crore, and after this result 20.4 crore taka. This is taxable in our country. Now if the tax rate is 15% for capital gain, and we also see SRO, is there any SRO for this special capital gain or another, so this will be taxed under this percentage. So if we consider 15%, that according to second schedule, 22 crore, that is 3.06 crore taka is to be given by the company for offshore indirect tax rules. Impact on economy. What is the impact of the economy? This section was available. Main section is 18 2C. So now is this digital rule is given for the finding out or clarification given by the government for imposing tax, especially for indirect tax rules. This is much stringent rule and a strict rule for attracting foreign direct investment. If in our Bangladesh EPZ or any other Chittagong or any other EPZ, there available share is being transferred like this. So this transfer will be held or attracted tax from now for this detailed rule. The foreign direct investor may be demotivated for this tax imposition. So dear viewers, I'll complete my my video for this time. I'll come with next with new idea and new content for your benefit and convenience. Till then, bye. Assalamu alaikum.